Manish Sonthalia, Vice President of Motilal Oswal AMC, joins us live. Manish, good morning. Thank you for joining us. Manish, first we saw a savage and a massive sell-off followed by a monster rally. So what's next now?
Call it a monster rally, I don't know. But I think what the markets would be watching out for is the Fed commentary on 18th. And I mean, there is a sense, given that commodities have started rallying, that tapering might not just come in September, and this is a view on a widespread basis. So if that be there, then this rally is definitely going to continue. But if it's not there, then maybe we can see fizzling out of the rally going into the second week of September.
Manish, you on the sidelines of your conference must be interacting with a whole host of global investors as well. Give us a flavor of what the sentiment is like when it comes to India at a time when the economy is decelerating and the currency is only weakening.
No, I think the mood is quite somber and negative, cautious, to be on the optimistic side. I think there's a lot of subdued anger within the participants given what's happening in the economy, what's the state of affairs are like. So it's not an out and out bullish scenario out here, but too much of caution and trying to nimble into stocks which are available at reasonable valuations and given the outlook by the management.
Let's talk about the crowded trade, which is IT. IT has been a crowded trade and it will remain a crowded trade. Do you think in the near term there is further scope of P expansion for large cap IT stocks?
Don't think so, Nikunj. I think it is going to move in tandem with the rupee. So it's now going to be whether the dollar appreciation and rupee depreciation translates into higher earnings growth. Markets are particularly building in 10 to 15% increase in rupee EPS for fiscal 2014 and 15 for all the large cap IT companies. So valuations are more or less full for the IT companies. If the rupee was to depreciate, then you could see further increase in stock prices for the IT companies. This is as far as the short-term outlook is concerned. But it's going to be more followed by earnings upgrade rather than P expansion.
Let me ask Manish Sonthalia, the fund manager, not the employee of Motilal Oswal Securities, which is one management which has impressed you at the Motilal Oswal conference, which is one stock you plan to buy now that you've attended the day one of the conference?
Yeah, so actually, Mr. Deepak Parekh actually spoke at our conference yesterday. Quite impressive. Then Dr. Kamal Sharma of Lupin. These two managements actually give us a sense that the outlook on the pharma space, and particularly the ones who have established themselves and proved themselves, have a good run in the next 3 to 5, 7 years going into the future, because there's a lot of opportunity. Dynamics are changing. As far as, let's say, Lupin is concerned, the focus is going to be more on biology side rather than the chemistry or the generic side of things, which was the case till now.
Manish, one part of the market which has healed the first is the entire metal universe. What is driving price optimism in metals, and also are you a buyer in metals?
No, not quite, Nikunj. We are not buyers in metals, but I think it is more of a cyclical recovery. As far as the ferrous side is concerned, the recovery started in America. Now there's a cyclical recovery happening in Europe. Given the fact that yesterday Chinese PMI data was more on the positive side than what the markets were anticipating, you have seen metal prices move up. But there is still surplus capacity in the system. Rupee depreciation is helping pricing, but demand is extremely weak. I think it's got to do with the tapering issue, because certain sections of the market do believe that tapering is not going to come in September.
Manish, from the financial stroke banking space, what do you own?
We are owning mostly private sector banks and some NBFCs. So just to give a few names, in a mid-cap portfolio, we are owning Bajaj Finance, we are owning JNK Bank, I'm owning City Union Bank, I'm owning ING Vyasya Bank, large cap space, we are owning HDFC Bank, State Bank of India is one exception to that.
Manish, is it time yet to start putting in money into cap goods and infrastructure names?
I wouldn't think so, Aisha. You are still not very clear as to where interest rates are headed. Because interest rates are really killing most of these infra companies, and even though there's a slew of announcements that have been made by the CCI as far as project clearance is concerned, outlook remains quite gloomy because there is shortage of capital, there is shortage of working capital, equities are not tied up, bank funding is hard to come by. So problems galore for the infra space as a whole. Are the markets pricing in a recovery? Maybe they are, but whether it's too early to call the shot, I will say yes.
Manish, are you buying beta in your portfolio with the assumption that in the second half things will stabilize, economy will come back, and when economy will come back, beta stocks will also make a comeback?
No, Nikunj, we are not playing beta in the portfolio at all. I mean, look at this way, GDP growth is still being revised downwards. I mean, we were thinking that 5% could be the low for the GDP, but now it's 4.5% is what we are looking at. So, and on cap goods in the IIP is still falling. So, we are not really playing beta at all. It's all about earnings visibility, buying at slightly expensive valuation, but that's how we are positioning ourselves.
Still own those expensive consumer names like Glaxo Consumer, Emami?
Sure, we are happy owning them because you are sure about the corporate governance, you are sure about decent earnings growth and outlook into the future, not just in the next 1-2 years, but the next 3, 5, 10 years. Somewhere down the line, the valuations would correct.
Manish, so what is the sense that you are getting from the FII as well as the local fraternity on the sidelines of your conference? We will see the new RBI governor take over. Do you think he will not have a choice but increase interest rates in the upcoming policy?
I mean, that's the way it should be, Aisha. I mean, if capital is flying out of the country and it's a wait and watch mode for the FII's policy action is not very clear. It's tilting towards populism. People are really not gung-ho about India. Many have in fact written off India for good in the near term. So all this points to an interest rate increase. And if that was to happen, then there would be capital moving out of the country. And India has always been a beta market for FI, so people would be happy selling the high beta names at distressed levels, but when beta comes back to these markets, then they're happy owning them even at 100% higher levels. So that's the way it is. I mean, you and I can't change that, and currently the environment is quite negative about India.
Whereas Ranbaxy, this was a laggard, a big underperformer, cracked completely, plunged to a multi-year low. But guess what? It's been a reversal of fortune for Ranbaxy. I want to look at the intraday graph for Ranbaxy. It's flat today, but flip it around with the 1 month change and you'll be surprised here. The appreciation is about 50%. 50% plus now, 60% for Ranbaxy. Manish, the fundamental concerns for Ranbaxy, they still exist. Whether it is the US FDA problems or problems or quality of medicines which were supplied in the local market. If the fundamental concerns are still there, what explains a 60% surge in Ranbaxy? This is not a small surge, this is a big surge.
I mean, the stock has been beaten out of shape and for rightful reasons, problems with the US FDA, then warning letters by US FDA, etc. But look at it this way, it's a 12,000 crore top line company available at a market cap of just about more than 1 time sales. Now, the trigger why Ranbaxy has moved up is because the base business has actually bottomed out. If you listen to the management commentary after the Q1 results, which is the June quarter numbers, you'll come to understand that the base margins have actually troughed and have seen a big uptick. And the next big triggers are obviously your Diovan and Valsite, which are huge blockbuster drugs, and opportunities in the US are there, big opportunities. Ranbaxy has its front end and back end all set. So, it's going to be additional profits for them moving into the next 2, 3, 4 years, even if you assume that there could be some significant price erosion, 60–70% price erosion, but hoping that they would gather at least 20–25% market share.
Since you've done your homework on Ranbaxy, are you in a mood to buy Ranbaxy?
Yeah, but since the stock has really appreciated significantly, it's there on the radar, but would look to buy at lower levels.
Manish, best bargains or best trades are always made when there is blood on the street, when there is outright pessimism. Currently, there is blood on the street. The market mood is extremely bearish and nervous. So, what are you buying?
As I said, Nikunj, there is blood on the street. Agreed, valuations are beaten down for bulk of the market, but visibility is not there. And where the visibility is there, you are getting stocks at reasonably to slightly higher valuations. I mean, the problem with public money is that if you take into account beaten down valuations, it does not really work that way. And because you are being marked to market on your portfolio on a daily basis, nobody has that. Even though portfolios are positioned for 2, 3, 5 years, I mean, it doesn't work that way. We all know that. So I think idea is to protect capital, keep the portfolio defensive till the broad outlook remains good. Beaten down stocks are there on the radar, but visibility in earnings is not there, and according to me, it's too early to pull the plug on these sectors and names just yet.
So completely steer clear, Manish, from the banking pack, or do you think there are some private banking names that you do like?
No, there are a lot of names which do have significant value, and after the correction that we've seen in the banking stocks, if I was to have some increase in exposure within the banking, within the beaten down stock space, then it would definitely be in the banking space.
Manish, so at the current juncture, is one better off owning a stock like Ranbaxy or a stock like Sun Pharma? Ranbaxy is a cheap stock, but there is little visibility. But Sun Pharma is an expensive stock and offers a lot of visibility.
I would be happy owning Sun Pharma rather than Ranbaxy at this point in time. Because there is visibility in earnings to the extent of 20–25% for Sun Pharma. They have proved themselves over the last 3, 4, 5, 10 years. Valuations are very reasonable, expensive, 1 lakh crore plus market cap, but the profit growth continues to be very stable, irrespective of the environment, without any hiccups. They do deliver 20–25% sort of an earnings growth. Would be happy owning Sun Pharma rather than Ranbaxy at this stage.
Manish, the argument for IT is strong. You've already flagged off for our viewers that what is your sense on IT? Large cap IT stocks are sitting at a multi-year high, but mid cap IT stocks have not benefited. If the market understanding is that IT stocks will benefit because of a weak rupee, then small cap or mid cap IT stocks should also have appreciated in line with large cap IT stocks, but that is not happening.
That's a disconnect, Nikunj. There's not too much of value addition work that is being done by mid-cap IT stocks in India. And if you try to play the tailwind of the depreciating rupee in mid-cap IT stocks, it's going to be a very cyclical sort of a pull-up in the stock prices. But the business models really don't support very extended prices to earning value multiples that should be assigned to mid-cap IT companies. And it will remain that way till they reach a critical size, a critical mass. And this rupee depreciation, maybe that is the reason it's not playing out on the mid-cap IT stocks the way it is playing out for large-cap IT stocks.
So Manish, just looking at the index per se, what could be the extent of this pullback, and would it be fair to assume that we may have bottomed out at about 5,200, or do you think 56 and 5,700 and again the market is going to be back to that 5,200 mark?
The probability of the market actually going down are still there till we pass the month of October. September and October are going to be very challenging months for the Indian equity markets. That's my sense. we could see the markets moving up to 5,700, 5,750, but there is a strong probability that markets could drift down again and maybe even closer to 5,000. That is what the general perception is, and if that was to happen, it would be on the lowest side of valuation that should be there. I mean, I am building in a case of somewhere closer to 4,900 to 5,000 being the worst case scenario. You have that in mind. You're trying to project the market for the next 2 years. I think in the near term, 5,750 looks on the upper side, and closer to 4,900, 5,000 on the lowest side. That is the range that the market should be in.
So what could be the next trigger point for the market that could perhaps aid a constructive move upwards?
In the near term, it would be a Fed tapering announcement on 18th of September. And domestically, I think revival of growth, which looks very unlikely in fiscal 2014 and fiscal 2015, it is going to be the election, which will be the deciding trigger for an upmove, sustained upmove in Indian markets going forward.
The big reset event could be elections. So Manish, do you think markets will start rallying the minute election date is announced?
No, I mean, markets are wanting Namo to come as the next PM. You can have a sense of that if you talk to people. So, there could be some rallying if they were to announce him as the PM candidate. But what the outcome of the elections would be known only when the next elections happen. But I think that is the next big trigger that we have for the Indian markets. There doesn't seem to be any other trigger. We are still seeing GDP growth being revised downwards in spite of such big developments on the good monsoon front, and which will have a good multiplier effect in the second half of this fiscal. So it could be export revival, it could be elections that we should be looking forward to in the next fiscal, and in the near term it will be the rupee, and which will depend a lot on what the Fed announces on 18th.
Okay, Manish, let you go on that note. Really appreciate you taking the time out, and you have a good conference there. That's the view coming in from Motilal Oswal on the sidelines of their 9th annual Global Investor Conference currently.